Ladies and gentlemen, good morning. Welcome to the fifth in the series of the Financial Rescue Caucus. The program today that we'll be covering will be topics relative to the risks, the state's finances, and as well as to the pension plan with some of the actuarial assumptions. I'm very pleased today to have both Rick Dreyfuss and Dan White here today. We're going to have every member going around introducing themselves. Our Vice Chairman, Jared Solomon, I'd ask you to keep him in your thoughts today. He's currently on active duty. And so he's down in Fort Knox, Kentucky. He's a National Guardsman, reservist, and he's doing a tremendous job, and he extends his best wishes. Many of our Democratic members were unable to make it today. They scheduled a last-minute caucus and retreat that's going on today as we go through it. So with that, again, it is being televised. So what I'll do is I'll start with Representative Judy Ward.
Hi there, I'm Representative Judy Ward, and I am from Blair County, the 80th Legislative District.
John Bryan, I'm the staff of the House Appropriations Committee.
Rick.
I'm Rick Dreyfuss, presenter, consultant, and actuary.
I'm Dan White. I'm head of fiscal policy research for Moody's Analytics.
Fantastic. Outstanding. And joining us right now is State Representative Chris Dush, who just came from an Education Committee meeting, so he's will obviously be enlightened. Welcome, Chris.
Thank you.
One of the things I wanted to mention to you, again, is somewhat of a background for what we're dealing with here today, is we have a situation where what we're trying to do is get to a ground truth of the major risks and the major concerns that we're dealing with in the Commonwealth, and we can craft public policy accordingly. And what happens frequently on fairly complicated topics is the in-depth knowledge of it. The devil is, unfortunately, in the details. One of the reasons that this has become an even heightened sense of need, I think, Rick and I have known each other for quite some time, and Rick's been bringing this issue to the forefront, that these problems that we're going to be discussing today will not go away. And as someone who's been doing bankruptcy for the better part of 40 years of my life, there will become a tipping point at which there is no potential solution that is acceptable to anyone. And I'm of the personal opinion that we're rapidly approaching that point. And I think we had an indicator, a very sad indicator, and there will be a second part of a financial rescue caucus today on the dairy industry. There does become that tipping point. I saw it in the steel industry. I've seen it in the railroad industry. I've had the opportunity as well to see it in the coal industry. And so what we're hoping with today, and we'll start with Rick, to discuss the Pennsylvania's fiscal challenges in the defined benefit and other post-employment benefit plans. But I do want to also remind everyone who will be watching this that starting with July 1st, 2018, the disclosure is now required under GASB 75 of the post-employment benefit plans such as health insurance, which has not heretofore been recorded on our books. We don't know the exact magnitude of that number, but once we see it, I want to really emphasize people that our time is running short for us to craft reasonable and rational solutions. So Rick, let me go ahead and start over with you. And what I mentioned, everybody, is we'll go on for about 20, 25 minutes. Then we'll have Dan present and ask questions for members.
Okay. Well, thank you and good morning, everyone. Just by way of introduction, my name is Rick Dreyfuss, and I'm a former human resources executive with the Hershey Company. And I'm also an actuary by trade for over 35 years. And I took an early retirement package and became a consultant. And in that capacity, I do various work for a number of think tanks throughout the country to try to help various states not only solve their pensions and post-retirement benefit problems, but understand how bad they are, because there is a learning curve on this, and an important one. It's very hard to solve a problem that is not very well understood. So part of my mission today is to try to increase the knowledge base, and happy to take questions as at the end of this session. I would, as you look at this, I would point out that we are facing some pretty significant demographic trends. For example, I recently read a publication that says by the year 2030, 20% of the U.S. population will be over age 65, and by the year 2035, we will have more senior citizens than we have individuals age 18 and under. So we are definitely looking at more people receiving benefits from retirement health care, Social Security, and this is going to put a tremendous strain on those still in the workforce because we have tremendous shortfalls in our plans, not only at the state level, but at the federal level as well. And this is the day of reckoning will be down in the future, and it's a very significant ccue, and the earlier we start facing our problems, the better off we'll be. So I have about 15 slides. It should take about 20 minutes just to give you an overview of this situation. I'd first like to start with, how should a defined benefit pension plan be funded? And I do this so that people understand what the end game should be versus what we're doing right now. And since we're dealing with these pooled arrangements, pension plans should be funded annually as benefits are earned and completely paid up when members retire based upon actuarial assumptions. These are long-term trends that are considered reasonable, and for the purpose of this, actuaries define reasonable as something that's at least 50% likely to be achieved. So if you can think of this as a group of individuals, and we're trying to properly pre-fund their benefits so that when they retire, all the monies are set aside for their future longevity in terms of retirement. That's how the plan should work. It's pretty straightforward and somewhat basic. And that if you look at any point in time, the value of the assets that are set aside or have been accumulated should basically be equal to the current value of benefits that have been earned. So the idea is you're supposed to have parity between your asset levels and your liability levels, and that's commonly referred to as a funded ratio. Are you 100% funded, which means nothing more than your current in terms of your liabilities and that you've accumulated. And just to give you some more precision here, if you're looking at an individual retiring at age 65, you need a reserve of about $10 for every dollar you want to pay out. Stated differently, if someone has a pension that you're projecting to be, say, $30,000, you need about $300,000 set aside in order to provide a lifetime annuity beginning at age 65. And again, that's assuming normal longevity and people retire sort of on time. And that also assumes a 7.25% rate of return on those assets. If you change that, then I have to, give you new numbers from which to deal. And so the ongoing process is members contribute to these plans. The employer contributes an annual, you can think of it almost as an annual premium. Plus, there's a supplemental cost, which is commonly known as paying off the deficit. In more technical terms, it's known as an unfunded liability. But you should think of that as no more than a debt or a mortgage that needs to be paid off. And it's a supplemental cost in addition to the ongoing cost of the plan. Obviously, if you have a 100% funded ratio, you have no unfunded liabilities, so you just have annual costs that you're contributing, again, towards these long-term goals. The important point is that this should be, any unfunded liability should be paid off over a period of 15 to 20 years. Why? To keep integrity with the financial model, which says that we ought to have accumulations by the time the average member retires. To put some specificity here, if you look at the average age of a school employee or state employee here in Pennsylvania, it's about age 45. And if you assume on average they retire at 65, that gives you a 20-year period. And if you want to pay it off sooner than that, that's fine. But that's how the system should operate. And so the unfunded liability is basically a reconciling items just to deal with any past experience. Sometimes benefits are granted retroactively. Sometimes actuarial assumptions change. All of that finds its way to the unfunded liability and ultimately creates debt that needs to be systematically reduced and ultimately eliminated, ideally over a 20-year period in time. That's how the system should operate. And I would underscore that public sector defined benefit plans must adhere to some internal revenue statutes in terms of how benefits are taxed to the individual, but there are no federal guidelines or mandates in terms of how a state should fund or not fund its particular pension system. That's under the domain of the policymakers, generally the General Assembly and the administration, to set forth the funding parameters into state law. So when I hear the annual required contribution, that is nothing more than following what is currently in state law, and so, which leads to the question, how do we know that the state law is reasonable, appropriate, and meeting the needs of the workforce and the taxpayers? I would point out that the ARC for SERS, that's the State Employee Retirement System, is based on a 30-year equal dollar amortization. Think of it as a 30-year mortgage, while as PSERS is on a 24-year, it's backloaded, which means the installment payments increased each and every year. It'd be like an increasing mortgage payment that is already pre-scheduled. So one takeaway from here is both of these periods are longer than the ideal and the preferable 20-year period, and because of that, we've compromised the financial model right up front because we won't have fully funded these benefits by the time individuals retire. That's a problem. And I would point out that there are a number of entities that study this, including the credit rating agencies, the government accounting standards boards, but again, to underscore, these groups have no authority over plan design or funding policies. They are mainly looking at credit risk or accounting practices or otherwise trying to do financial analyses. So again, every state has its own domain in terms of how the policy should be developed and implemented. Okay, so one question is, how large are the unfunded liabilities here in Pennsylvania? And what I've tried to do on this slide is try to summarize it for your benefit. And the first thing you'll see is that I've looked at the public school employee system, the state employee system. We have over 2,000 municipal pension plans here in Pennsylvania. Also is the other post-employment benefits that Frank mentioned earlier. That's you should think of that as retiree medical benefits principally. And we're on a pay-as-you-go system there. There's no pre-funding for this. So, and you also know that the reporting dates are not completely lined up, and that's because these measurements are not taken all at the same point in time. So I'm aggregating numbers that are of different measurement periods, but nonetheless, I think you'll get the idea of how big these numbers really are. So in the third column, you'll see I've tallied the deficit, and this is the accumulated deficit based on benefits earned to date, otherwise known as the unfunded liability, $91.9 billion, and again, that's predicated on a 7.25% rate of return. And the funded ratio is how close are we to paying off this liability that we've incurred, and you see for our pension systems, we're below 60%. And municipal pensions, again, around the 66% level. The OPEB plans, since they're not pre-funded, we've obviously, all the liability is unfunded. And then just for illustrative purposes, but equally important, is if you use the market value of assets, because the actuarial value of assets is a rolling average of assets, and I'll talk a little bit more about that shortly. But I think it's important to look at both sets of figures, and you see if you base it on the market value of assets, and I tend to have a sort of a bias in favor of that because it keeps you more current and more accurate in terms of your measurements. You see the unfunded liability is $97 billion, so we clearly have a large number, a big debt that somebody's going to have to pay for at some point in time, and this number grows with interest every day. And my good friend Barry Shutt has a clock right outside this room which keeps real-time accuracy in terms of SERS and PSERS, so the number is increasing. Let's talk a little bit about the rate of return that one can reasonably expect. Milliman, which is a leading consulting actuarial firm nationwide, comes up with a pretty systematic way of looking at this. And in 2017, their composite expectation for pension systems is 6.71%. And that's a bit sobering, given that it's certainly short of the 7 to 7.25% and 8% that you find in some cases, which should be a red flag that not only are we running uphill, but we're going to have newly found liabilities going forward. And they've also created a 20-year outlook in terms of what they see in different asset classes. And if you look at the May 2017, and again, this is one estimate from one company, and I appreciate their ability to be right or wrong, but nonetheless, I think it's an important schedule to consider in terms of the reasonableness of this. And the suggestion would be, if you're going to earn 7.25%, well, you probably need to be overweighted in terms of private equity, which entails a lot of investment risk, as many of you know. And in fact, that's what a lot of our public pension systems have done in order to substantiate their rates, because clearly the other asset classes are not going to support that. It's either that or you lower your expectations going forward. And in fact, if here's a slide from our state employee retirement system, which where they did about a year ago a schedule of risk and return, and you see in the green box that was their current allocation, and at that time they were using a 7.5% rate of return, and they had to make a decision whether to reallocate their assets to a more riskier model or lower their expectations, and they chose to lower their expectations in this case from 7.5 down to 7.25%. That simple action, if you will, increased their unfunded liability overnight by $1 billion. So this is that's more debt to pay off, and so there's a moment of truth in terms of the expectations. Now, mind you, the returns will be whatever the returns are, so it's just a matter of what your measurement point should be going forward. Here is a schedule where I've tried to summarize the current ongoing costs to our pension systems, and there's a lot of moving parts here. And I would also note that a lot of this is dependent on compensation levels, which are constantly being updated. So these numbers can move around a bit because they're based on a certain percentage applied to an estimated payroll. And as that payroll changes, so do these numbers. But I think it is telling that, for example, in the total PSERS, which is about $4.49 billion for the next fiscal year, represents about 1/3 of payroll. So school districts are going to have to contribute about 1/3 of payroll to these pension systems. And you can see that the numbers have increased steadily, and they will continue to increase probably until about 2035, where they're projected to reach a maximum rate of about a little over 40%. So we are definitely on an upslope here, and this is a big fiscal challenge. I would note that the state also contributes probably about half that cost. So the PSERS funding issue is an issue for the general fund, but it's also back in your local districts, deals with property taxes, because that's how these school districts are funded. And the state employee system has a cost, obviously, going up as well. So this is a schedule just to give you an order of magnitude in terms of what we are facing. And then in the bottom box, I've tried to indicate what kind of incremental cost over and above these numbers would be required if we were to, say, reduce the amortization periods to 20 years or less, or use the market value of assets versus a rolling average, or even use a level dollar amortization. What that means is a mortgage where the annual contribution is constant year after year. And based on this analysis, we will need, if you did everything, now you don't have to, you can do this in parts or phase it in, but it would probably require another $1.5 billion at state and local levels combined to implement what I would call funding reforms, and that's over and above what we have here. So as bad as the costs are, and they are bad, we still need long overdue reforms, again, because we've compromised the basic pension funding model. Some people ask, how do, since we're, at least up to this point in time this year, we were experiencing a pretty bull market, but markets are very volatile these days, and people are asking, well, if we have a great asset year, does that help our contributions? And that's a very fair and reasonable question. What you need to know is that the asset values that are ultimately generated are averaged over a 10-year and 5-year period for PSERS and SERS respectively. And I would quickly note that the 10-year is not compliant with actuarial standards. And if you go back to Act 120 of 2010, it is very clear that the actuarial note that accompanied that bill said this does not comply with actuarial standards. Notwithstanding that, all in favor of the bill, and the bill passed. So again, actuarial notes have no statutory impact other than identifying and highlighting issues. 5 years is the maximum compliant term. Again, there's no law saying you can't use the market value, which is a no-year averaging. It's the actual value. So the result of these rolling averages, whatever period you look at, are computed each year and then compared to the rolling average from the prior year. And the question is, did that rolling average grow by 7.25%? And if the answer is yes or no, any variance is then amortized over 24 or 30 years. So the takeaway from this is that 1 year is not going to significantly move the contribution rate. And whether that's good news or bad news, I'll let you decide. But and one of the reasons they put in the 10-year rolling average was back in 2008, we had a market downturn, and they didn't want to have to increase contributions at that point. So what they did is they expanded the averaging period to 10 years to try to mitigate those costs. And there are all kinds of financial techniques at work. And, the actuaries in this are basically scorekeepers. They are not here to certify that the action taken by the General Assembly or the practice followed is indeed the right one. I mean, that's a matter of public policy. I'd just like to highlight, in my various dealings with various members, there's a number of misconceptions and half-truths that come out, and I'd just like to sort of underscore this for the benefit of this group. Number one, I hear so often that the unfunded liability is an interesting number, but it only reflects reality if you assume everyone retires today. And that is 100% incorrect. It assumes people retire on their normal retirement dates, experience a normal longevity, and all it is the deficit, but measured in today's dollars. It's a sort of a how are we doing type question. Sometimes I hear in defined contribution plans, people are woefully behind where they should be and they'll never have enough money to retire. Well, this is the defined benefit version of that. We are woefully behind in terms of our asset accumulation, otherwise known as in a defined benefit plan. It's an unfunded liability. But the key point here is that this is the current value of our existing deficit. So anyone who says it reflects the deficit, assuming everyone retired today, is just not dealing with facts. Number two is that we often hear, well, we have this actuarially recommended contribution. In fact, you've heard people say, for the first time in many years, we're going to be contributing the ARC. And we should all take comfort in that. And they suggesting somehow that these standards are based upon outside and independent standards ensuring proper funding practices are in place. No, it's nothing more than, are we putting in what the state law requires, which goes back to the question, is the state law indeed the correct one? So when someone says we're contributing 100% of the ARC, we're contributing 100% of what state law requires. And in my view, we're contributing 100% of a deficient rate. So if there's little joy in that. So just be aware that these terms are obsolete. They've been abandoned years ago, but still I hear them in the halls of this Capitol bandied so often. In fact, if you use the market value of assets, the contribution to PSERS for next year will not even cover the interest cost on the unfunded liability. So we are not making progress on that particular score. Number 3, people say Act 120 just needs more time to work, and that's just not true. That model where there were identified savings was completely compromised 2 years after that when we lowered the assumed rate of return from 8 to 7.5%. That created more liability overnight than we were supposed to save cumulatively over 30 years. So I will admit that it did reduce the benefits, but the idea that this is a cost saver and will reduce the unfunded liability just is not borne out by the facts. And number 4, both PSERS and SERS continue to experience negative cash flow. So when we talk about growing assets, this is not like a static amount that is we're adding money to, and we just hope it grows at 7.25%. In fact, the combined annual annuity payouts from these two plans is about $10 billion a year. There's a lot of dollars going to a lot of annuitants from these plans, and indeed, it's hard to grow an asset base with negative cash flow. Number 5 is and this was somewhat evident in the more recent reform legislation, the current unfunded liability can be reduced by reducing benefits for newly hired members. That's not true because newly hired members, their numbers are not in the unfunded liability. So it's a little hard to say, well, we're going to hire these people and give them lower benefits, and that somehow is going to reduce our current debt, and it's just not the way the math works, unfortunately. The only way you can reduce an unfunded liability, there are 3 ways, and one is you can reduce the benefits for current members, and that runs into a lot of legal issues and a lot of political issues to boot. Number 2, favorable plan experience. We can hope that we overachieve our 7.25%. People don't live as long. People leave the workforce early. People don't get the salary increases that were otherwise assumed. So favorable experience will help the unfunded liability. That's, to me, somewhat unlikely. I mean, you can hope that we earn double digits, but I just don't think that's in the cards. And that was borne out by some recent studies that I shared with you. And number 3 is you can increase contributions. That, of course, raises questions of, how you're going to pay for it, which is a little bit of a strange question because we've already incurred this debt. So it's not like a new expenditure. This is how we're going to pay for something we've already promised. Others I've heard from time to time, they say Act 5 of 2017 was an effective means of capping or slowing the increase in the unfunded liability. Again, that's false. Unless you believe that the 7.25% will not be achieved, because individuals come into a plan with no unfunded liability. They don't add to it. They don't detract from it. They assume, because the assumption is you're going to properly fund the benefits for the new hires. So, stopping the bleeding, slowing the increase, that's just, if that happens, it's because we've had good experience or we're paying down the debt, but not because of the new plan design, which incidentally will be effective in 2019. Some people believe new entrants are required to sustain a defined benefit plan. Well, that's not true either, because that almost suggests it's some kind of legalized Ponzi scheme, that we need new money coming in to pay people. But if you think about my first slide in terms of how this should work, we should have all this money set aside by the time people retire. And in fact, new member contributions go to reduce new members' benefits. The reason you contribute, it's very similar to contributing to health care costs, is to reduce your premium. A new member or any member contributes to the pension system to reduce the premium, the cost of their plan, not to subsidize someone who just retired. And when you hear that, again, you should think that the financial model has been compromised. Ironically, many of the Act 5 savings, I use that word in parentheses, were modeled using an asset return assumption of 6.25% associated with new hires. And what they said is, well, if we put these new hires in and only assume 6.25 and only earn 6.25, we'll be much better off than had we assumed 7.25%. And that's true. And they said, well, think of all the money we'll save because we won't have put them in the 7.25 system. Well, that's true too. The only problem is, we're sort of joining this game in progress. And there was never, when I hear this, there was never any consideration or analysis done to the existing unfunded liability, where if we only earn 6.25%, or if we modify our assumptions down to 6.25% for the existing liability, that would create a new unfunded liability to the tune of $12 billion if we change that assumption today going forward. And that would clearly vanquish any savings that would be generated from these new hires, isolated as a separate group. So you got to look at these systems in their entirety and take the long view of this. And the long overdue pension funding reforms that I highlighted on the previous slides are found in House Bill 778. That's John McGinnis's bill. I think it is well crafted and would encourage you to consider that bill going forward.
And if we could, Rick, one of the things I want to do is, because we've deliberately had you and Dan scheduled together, what I was going to do is if we could load Dan's now, because what I'd like to do is do part of Dan's and then come back to your remaining 4 slides.
Okay.
Because I think what it will do is it will serve as a really good outline and frame the 2 issues together from that perspective. And then, is it okay with the members if we wait until Dan gets his part done and then ask questions? Sure. Is that okay with you, for both of you as well? Sure. And then what we're going to go ahead and do is we're going to go ahead and load the Dan's presentation.
Yep, I can do that.
And as we're waiting for this to be loaded, I think one of the things that's an interesting aside, this is a science. Actuarial reporting has an analytics is not for the faint of heart, if I might say this. And and that's why your true, false, and your important facts, I think, are so important, is that most people who are involved in analytics or actuary science really don't have a political basis to what they're doing. They have a mathematics basis behind it. And that's where, just so everybody's aware, Dan wrote an article that Jared Solomon forwarded to me that I think really pinpointed a great deal of the issues that we as legislators should be taking into consideration so that we don't inadvertently find ourselves in a position to where the political solutions to the Pennsylvania funding crisis becomes problematic. So with that, we're waiting to see if we can go ahead and load it up.
I think we broke the computer.
Yeah,
We
the
did.
computer just died, like it stopped.
It was bad news.
It was so bad news, the computer didn't even want to see it.
Dan, would you like to do this while we're trying to load
Yeah.
it up? Would you like to go ahead and get started? And
Yeah, we
again-
can get started.
And Dan, I really, once again, want to really thank you and Rick for coming down and doing this. This is really helpful. And we're going to have I know I've got a ton of questions. I know we're all going to have a ton of questions for you.
No worries. Well, thanks, Mr. Chairman, I suppose, of the caucus. Thank you for having me here today. It's a pleasure. I do get to do these all kind of throughout the country, and so I'm glad to get to do it here in Pennsylvania because I'm a taxpayer here in Pennsylvania, and so when I go and speak in other state capitals, a lot of times I get questions about what's going on in Pennsylvania, so it's nice to be here in Harrisburg. One of the things I wanted to lead you with is kind of my background. I used to be, in a past life, a legislative economist in the state of New Mexico before I came to Moody's. So I do have a unique, I think, picture of what you all are going through in terms of putting together a budget. When I came to Moody about 8 years ago, one of the things I learned that is constant from the public sector to the private sector is that you should always make the lawyers happy. And so I have to have a little disclaimer before I speak every time, just to make them happy. I am in charge of public sector research and municipal finance research for Moody's Analytics, which is an entirely separate company from Moody's Investor Service, which is the ratings agency. So we're both owned by the same parent corporation, but there the similarities end. So please don't let anything I say today be misconstrued as having any bearing on past, current, or future ratings actions. And on a personal note, please don't come up to me afterwards and ask why I did or did not downgrade so-and-so, because I had nothing to do with it. I get you in touch with the people who did, but that's about as much help as I can be. But what I did come to talk to you about was economics. So I am an economist by training, which is less of a science than actuarial sciences, but it's still a science nonetheless. And one of the reasons that I do this presentation in state capitals, and one of the reasons that we wrote the article a few months ago was that we are at a unique point in the business cycle. So when I give advice to policymakers and governors today, it's usually that the next year and a half is about as good as you're going to see from a state revenue standpoint, from a state economic growth standpoint. We are in year 8 of the current business cycle. So it's been 8 years since the end of the Great Recession. And for those of you keeping track at home, that is about to be the second longest period of expansion in modern American history, right? Now, it doesn't take a PhD in economics to figure out that we're very at or near the top of the business cycle. And similarly, it doesn't take a PhD in economics to figure out what comes after the top of the business cycle, which is the bottom of the business cycle. So we don't just have recessions on accident, right? We don't just go into a recession because we haven't had one for a while. But if, just for context, and I'll have a slide that'll show this, if we were to get to the end of fiscal year 2019 without another recession, that will be 10 years exactly since the previous recession, and it will be the single longest period of expansion in modern American history. Now, again, we don't just go into a recession because we haven't had one, but if you look at the past 30, 40 years worth of recessions, they have been at least in part self-inflicted, and 10 years is a really long time for us to go without screwing something up. So I personally take the under in terms of that 10-year time window. Our baseline forecast at Moody's is that we have another recession sometime in mid-2020. It's kind of your good over-under mark in terms of predicting the next recession. There's still a lot of reasons why we can go for the next year and a half, 2 years without another recession. There's a lot of economic stimulus that's going to be hitting the economy in the next 6 to 12 months. There's no very obvious signs of a bubble or anything forming in the economy right now, but that's usually what somebody like me says as a bubble is forming in the economy. So you take that with a grain of salt. But one of the things that we wanted to focus on, as I worry less about the actuarial sciences and more about what the economic impact of what you all do as policymakers here in Harrisburg is and what the effect will be on the economy of your actions. One of the things that we found, if you go back and you kind of diagnose the Great Recession, was that states in general were not prepared for any downturn in the economy, especially one with the magnitude of the Great Recession. And that is fairly universal across all states, not just in Pennsylvania. And what we found was that those states who were less prepared going into the Great Recession performed worse in the 2 or 3 years following the Great Recession. They were longer to come out of the recession. Some of them have still seen structural changes in their fiscal policies that are just borderline unfixable at this point because they were in such bad shape going into that recession. And so talking about what that could be going forward should be a key point of concern for anyone who's in charge of a budget, whether it's at the township level all the way up to the federal government level at this point. We have seen really a new normal in state and local government budgeting over the last 10 years. And some of that is a result of the Great Recession, but some of it is because of structural changes that are much longer term than beyond the Great Recession. They were things that were really just exacerbated by the Great Recession, not necessarily caused by them. And so if you look at, if we had a chart, we're not going to have a chart?
We have to replace the computer. It died.
Oh, okay, no worries.
I invented the first computer. It was one of the first ones we came up with.
It is? You got the floppy disk, the punch card to shove inside? No worries.
He should have backup in about 5 minutes.
No worries, we can talk through it. So if you look at state government employment, for example, over the last 10 years, just nationally, state governments have never lagged the rest of the economy by a greater degree than they have today. In other words, if you look at one of the reasons that the Great Recession was so bad and the Great Recession was followed by the not so great recovery was that a lot of the jobs that we regained in the recovery were not the same jobs that we lost during the Great Recession. So if you look at high-wage jobs, for example, 5 years on from the Great Recession, we had more than regained all of the high-wage jobs we lost nationally in the Great Recession. Low-wage jobs, we had more than gained back all of the jobs we had lost before the recession. But if you look at mid-wage jobs, which is where the majority of state and local government employment falls, we are still about 200,000 jobs short of where we were when we went into the Great Recession nationally. So just for some context, if you were to lay off every state, local, municipal, school district worker in the state of Maryland and never get them back, that is the size of the hole that we're missing in terms of that mid-wage job loss. That's about, if you look at what was the carrier manufacturing plant that everybody made a big deal about, and basically we've lost 200 of those, and we haven't gotten them back from the Great Recession nationally. That's a big deal. And if you look at the industry by industry checkpoint, all of that weakness is in the state and local government sector. Now, you could make the argument, and I think you could make a good argument, that not all of those jobs necessarily in state and local government needed to come back. But certainly a lot of them needed to. And one of the reasons why they haven't is that state and local governments are more stressed today by structural issues like pensions, like other things, than they have ever been in the past. And as those make up a larger and larger share of state government budgets, there is less money to go around for all of the discretionary items that we like to spend money on. If you go out and you ask the average person off the street, what does government do? In addition to a lot of smart aleck responses about not much, what you'd probably hear is, well, government pays for schools, they pay for roads, they pay for police, they pay for firefighters, all the things that we learned as kids the government does and should do, right? But if you look at what a state government actually does in terms of where the money goes, most of it is an insurance company, it's a retirement company, it is all these things that you wouldn't think about when you, in terms of assigning government responsibilities in the economy. And because state governments are a zero-sum game, every dollar that we spend on Medicaid or every dollar that we spend on pensions is a dollar we cannot spend on schools and roads and things like that. And so that crowding out effect is something that's becoming much more structurally apparent. Now, there are really three reasons why things are structurally different today than they were before the Great Recession. And again, not all of these are necessarily the result of the Great Recession, but they certainly were exacerbated by the Great Recession. Now, the first thing that we want to talk about is one of the reasons that states overlooked how much money they should have had put away before the Great Recession was that states in general budgeted off of a very ancient reserve policy, which is in 1977, somebody from Standard & Poor's Ratings Agency was asked, how much should a state government have put away in reserve? And the answer was about 5%. Now, that might have worked very well in 1977, but that's not exactly working very well today. But because no one had ever thought to look at this in detail and update those projections going forward, up until 2008, if you ask the average state, how much do you have put away in reserve, the best states would say we have about 5% because that's what we think we should have. But what we found during the Great Recession was that, especially in this day and age, recessions affect state budgets much differently today than they did even 20 years ago. And part of that is that recessions impact revenues and spending, right? So 5% may be enough to put away to get you through the revenue volatility that you're going to see as a result of the recession, but it's not going to get you through the increase in Medicaid, the increase in food stamps, all of those increased mandatory spending items that are going to go up because of a more dire economic situation, right? When people lose their jobs during recession, they don't just pay fewer taxes, they also apply for unemployment benefits, they apply for Medicaid, they apply for all these social assistance programs, and those programs are mandatory programs that have to be spent on during a Great Recession. And so oftentimes the crowding out that comes from those increased social services spending programs can be just as powerful as the decrease in tax revenue that you see. And one of the other things that we saw was that those social services programs are much more reactive to the business cycle than state taxes are. So if you were to go back to 2008, and I can remember being in the state government in 2008, we were in New Mexico in July of 2008 doing a revenue forecast, because I was part of the consensus revenue forecasting group at that time. And oil had just hit $142 a barrel. I don't know how familiar you are with New Mexico. New Mexico gets a lot of their money from oil and gas severance taxes. And so we thought we were being conservative, and we said, well, it's going to stay at $140 a barrel for the next 2 years. And we thought we were being conservative because that morning, Goldman Sachs had actually come out and said that oil is going to hit $200 a barrel before the end of the year. By the way, on a side note, if you're ever looking for trying to guess what the turning point in the economy is going to be, usually whenever Goldman Sachs says that some crazy thing is going to happen within the next year, that's the day that everything turns around, right? Because within 3 months, oil was down to $50, $60 a barrel, and before the end of the year, it was at $30 a barrel, right? So keep in mind the timing there. So we're doing a revenue forecast in July of 2008. Anybody know when the Great Recession technically started? It was in December of 2007. So we were already 8 months into a recession, and we were doing a revenue forecast. We did a special revenue forecast in July because I remember New Mexico legislators gave out tax rebates to everybody in August because we had so much oil money we didn't know what to do with it, right? So we're giving out tax rebates 8 months into a recession. 2 months later, in September, Lehman Brothers goes underneath, and everybody all of a sudden realizes, oh my gosh, maybe there's a little bit more to this than just high oil prices. Within the, I can't even tell you how many times we went back and redid the revenue estimate between July and the end of that year because we kept having to second guess everything in the revenue forecast. The moral of the story, though, is that even though we as revenue forecasters and the folks in the tax department had no idea that we were going into a recession in August of 2008, there was at least one person in our state and every state who knew or should have known that we were already in a recession at that point. Anybody guess who that was? Treasurer. Not the treasurer. Oh, he maybe should have known. It was the state Medicaid director, right? Because if you look at the increase in state Medicaid spending in the first 2 quarters of 2008, they were huge. Huge spikes in Medicaid enrollment in the first quarter and the second quarter of 2008. So for 6 months before we did that revenue forecast, they knew that information. We didn't know that information. And we should have been paying attention to it. And we weren't. And because we weren't, we had to go back and we had, I think, 3 special sessions in that year to go back and change the budget. That's not just a New Mexico specific story. That's something that happened everywhere throughout the United States. If you ask any state budget director who was in power or in office in that period of time, most of them will not have realized that we were in a recession until at least August or September of that year. 8, 9 months into the recession. And the reason is, if you look at state tax revenues, and if we get this working, I'll show you the graph, state tax revenues didn't actually see year-over-year declines until the first quarter of 2009. And so if we were just planning for the recessionary effects on our revenues, we were underprepared for that Great Recession because we weren't ready for these big increases in Medicaid spending, right? Now, why was that different in 2009 than every other recession that we had ever had? Why don't we know to look at Medicaid, from 30 years ago? And the reason is that, as Pennsylvania knows very well, that Medicaid makes up a much larger piece of state budgets today than it ever has in our history. And in fact, Pennsylvania, that number is particularly acute. If you look at state averages using the National Association of State Budget Officers data, in 1985, so just over 30 years ago, the average state spent about 9% of its budget, so its state budget, not the overall state and federal combined budget, but just the state-owned source budget, spent about 9% of its own source budget on Medicaid. Today, the average state spends over 20%. In Pennsylvania, we spend almost 30%, which is the highest or very close to the highest of any state in the country in terms of our own source revenue that goes to Medicaid. I'll repeat what I said earlier. State budgets are a zero-sum game, so every dollar that we are spending on Medicaid is a dollar that we cannot spend on any other program. Now, because that's such a large piece of the budget now, when we have a recessionary uptick in Medicaid spending, that has outsized impact on the rest of the budget today from what it had 10, 15, even 20 years ago. And unfortunately, given the path that Medicaid is on in terms of the year-to-year percent change in Medicaid versus the year-to-year percent change in state government and state revenues, that percentage is just going to continue to increase out into perpetuity in every state, not just in Pennsylvania. So if you look at it is just a coincidence. I checked. The last report that came officially out of the Obama administration, the day before the Trump inauguration, was the CMS report, so the Centers for Medicaid and Medicare Services annual actuarial report. And so what the Obama administration projected was that in every year over the next 10 years, state Medicaid spending, so this the state share, is going to increase somewhere between 6.5% and 7% a year, every year, out into perpetuity. For context, over the last 30 years, state revenues nationally have increased by a little less than 5%, which means that even if you assume that state revenues are going to continue to grow at the same pace that they have historically, there is always going to be a 1.5% to 2% gap between what's going out the door in terms of Medicaid funding and what's coming in the door in terms of state tax revenues to pay for it. Now, that's not something that states can, in and of themselves, necessarily regulate on their own. That's something they need a lot of help from the federal government to have. But what it underlines is the fact that states should be doing everything they can through the use of waivers and other outlets to try and minimize that growth in Medicaid spending year over year going forward if they want to keep that anywhere close to sustainable in the future. Ultimately, it's going to need a federal fix, but state governments can do what they can to minimize that growth rate going forward. But every year out into the future, we have that gap. Is another year that Medicaid is going to be more important and more necessarily damaging during a recession than it was in the past. So that's reason number one why today is much different in terms of recession impact than it was 15, 20 years ago, right? Now, the other side of that is the revenue side, right? And so the revenue side, while I don't want to minimize it by talking about Medicaid, because if you look at the annual, the recessionary impacts on state budgets, still about 80 to 85% of it comes via the revenue channel. Not all of it comes via Medicaid. And one of the things that we talked about during the Great Recession was that state tax revenues were more impacted by the Great Recession than they have been by any recession up to this point, and that includes the Great Depression. There's a lot of reasons for that. First and foremost, if you look at the volatility in state tax collections, so this is, again, looking at overall U.S. tax collections, state tax revenues were 3 times more volatile in the first decade of the 2000s than the underlying economy upon which it's levied. So just break that down a little bit. So if you look at the standard deviation in tax revenue receipts, so year-to-year percent change in tax revenues, it was 3 times larger than the standard deviation in GDP growth. Nominal GDP growth, right?
Our heroes got the system back up and running.
Awesome. Just in time for, this is one of my best charts then. This is great.
They're all good. By the way, for the members, I will have copies of these electronically sent to you as well. You're both, I hope you're going to be deluged, you will be deluged with questions, I know. So.
Oh, no problem. So, all right. So this is, there we go. So this is the chart showing the business cycle stuff that we talked about, the difference in state government spending versus state government revenues. This is our spike in Medicaid spending nationally, and you can see that revenues really took until very late 2008, early 2009 to fall. And then this is the happiest chart I have. This is the Medicaid path. So since 1965, that green line, that is how much we've spent on Medicaid, if you index that to 1965. And the green line is state tax revenues. So now that I've bummed you out twice in terms of telling you and showing you, this is what I want to talk about in terms of increased volatility in tax collections. So if you look at volatility in tax collections is not necessarily a new thing, but tax revenues are a function of the economy upon which they're levied, right? And so the more volatile the economy, the more volatile tax revenues you see. Which is why it was no surprise that in a decade bookended by recessions, we had relatively volatile tax collections. But when you look at tax collections and their volatility relative to the underlying economy, this is something that we've just never seen before nationally. It just hasn't happened. And there are several side effects to that. The first is, and this would be a good guessing game, can anybody guess how many times national aggregate state tax revenues have declined going back to like 1950? How many years out of those 65 plus have state tax revenues actually declined year over year?
I would say two or three.
2 or 3. 2 or 3 is right, but they've all happened after 2000. So before the year 2000, state tax revenues had never declined year over year in the aggregate. So something is different.
If I could ask you a favor, could you just let my wife know that I got something right once?
You did. I'll send the email.
Thank you very much.
So really, state tax revenues declining even during a recession. And there's some really bad recessions here. I mean, we talk about the late 1970s, early 1980s, the 1991 recession. It really wasn't till the dot-com bubble burst in the early 2000s that we actually saw a decline in revenues year over year from a national basis. Now, there are states who saw declines, obviously, but in the aggregate, not all states had ever declined before. So this is a new function of the new kind of reality in state budgeting. And there are several reasons why. The first is, over this time period, state tax revenues, the structure of state tax revenues have changed considerably. So if we were to go back to 1950, 1960, most state tax revenues would be coming in the form of property taxes and sales taxes. Tax revenues that are very stable over time, that are very good at matching the economy, and do not have major fluctuations from one year to the next. They don't. They're very stable. As the U.S. has changed from a more manufacturing-based economy to a more service-based economy, states have, almost by necessity, switched their reliance from property and sales taxes more to personal income taxes and corporate income taxes. And a result of that is that personal income taxes and corporate taxes are much more volatile than the underlying economy. And that's because they're not based on consumption, they're based on incomes, right? So my income might switch wildly from one year to the next, but I'm probably buying the same amount of food, the same amount of house, the same amount of stuff for my kids every year, regardless of what my income is doing. And so you'll see much wilder swings in personal income taxes than you will in sales or property taxes. What happened really in the last 20 years is that two things. One, states in particular have become much more reliant on very progressive personal income taxes. And from a tax equity standpoint, there's a strong argument to be made for that. But one of the side effects of that increased progressivity is that some states have become too progressive in their income taxes. And the result of that is that you see this heightened volatility in their income tax returns because they're relying, if you think of portfolio theory, they're putting all of their eggs in one very volatile basket. They're relying very much on a very small number of taxpayers who have a very high income. And those high income folks already have some of the most volatile incomes anywhere. I mean, if you've ever met a really wealthy person, they can make $15 million one year and they can lose $20 million the next, right? And their income statements, income taxes are going to reflect that. And the more that you rely on them for income taxes, the more your personal income taxes are going to reflect that kind of pattern. The second thing that we have done collectively as states over the last 20 years is we've become much more reliant on economically targeted tax incentives to initiate economic growth. And again, that's not a bash on economically targeted tax incentives. Oftentimes they work very well, but when they are working, some of the fastest growing pieces of your economy are growing tax-free. And so from a revenue forecasting perspective, it's very difficult for us as economists sometimes to figure out what taxes should be because there's a disconnect between what's coming in the door in terms of the economic statistics, so unemployment, GDP growth, personal income growth, and what is actually coming in the door in terms of tax revenues. And one of the things that states have been, and I can't speak much to Pennsylvania on this because I don't know, but in general, states have been very poor at documenting those economically targeted tax incentives and tracking them to see exactly how much money is actually going out the door in terms of economically targeted incentives. And that makes it very difficult to project one, whether they're working or not, but two, what the impact will be on your state budget, right? And so we see this increased volatility, and what that means is if we go into the next recession, that the decline in revenues from the downturn of the business cycle is likely going to be much more acute than it has in the past, which means that we're probably going to have more money put away for that next recession than we have in the past, right? So that's one. So number one is that we're spending a lot of money on pensions and Medicaid, and that's a bigger piece of the budget, and those stress during recessions. Second piece is that our revenues behave much differently relative to recessions than they have in the past. Now the third piece is that states, again, were just very ill prepared during the Great Recession for any type of downturn. And you can see that here. So the 5% number that I mentioned in 2008, states thought they were in great shape because they were right about 5%, which is what everyone had told them up to that point is what you needed. And then they realized very quickly that it wasn't what they needed, right? One, it wasn't what they needed, and two, what many states, the trap that many states fell into was they had these large reserves set aside for a rainy day, but they were very ambiguous, they were very nebulous. There's nothing in there that says this is, break glass in case of emergency, and nobody ever defined what an emergency was. And so a lot of states spent 2 years arguing about whether or not it was time to break into the rainy day reserve fund, and by the time they did, the economy was so much worse off that because of the interim extraordinary fiscal steps they had to take, that in many cases the revenues or the reserve funds didn't do much good at that point. And so one of the things that the Pew Center on the States and we have done and several other think tanks have done is they've emphasized that not only do you have to have a healthy rainy day reserve fund, but you need to be very specific and very explicit about what that rainy day reserve fund is for. Is it a permanent fund that's there to stay there in perpetuity? Is it an emergency fund to help smooth out changes in the business cycle? What is the intent of that fund? And that's almost as important as having the fund in and of itself. So the good news is, and I would like to think that we've had something to do with this, is that states are better prepared going into this recession than they were going into the Great Recession. So if you look at the average state, they're somewhere around 6% is what they're forecast to be at the end of fiscal 2008. That's the average state, right? That's still not enough. One of the things that we did was, instead of trying to guess how much is enough, because again, 5%, and I gave a speech like this one time in front of a group of municipal bond analysts, and I told the S&P story, and one of the people raised their hand and said, that was me. I actually had met the guy in 1977 who gave this speech for S&P, and so this, and I asked him afterwards, I said, where did that 5% number come from? He said, we thought it sounded good. There was no science behind it at all. It's just they thought 5% was a good number for that. And again, this was almost 50 years ago. It was a good number for back then. It's not a good number for today. So in order to come up with what we thought was a good number for today, we tried to bring in a little bit of science to it this time. And we borrowed a page from our friends in the banking industry, and we said, well, banks are required to stress test. All these other institutes or institutions are required to stress test. Why have we never stress tested a state or a local government? And so we wrote this paper, and we went through and we stress tested states. And what we found was that the average state needs somewhere in the range of 10.5% of their general fund budget put away in reserve to survive a recession for 2 years without having to raise taxes or cut spending, right?
Can we get a copy of that study?
Absolutely, absolutely. Mm-hmm. It's a much longer and much more boring version of the article, I think, that you read.
I thought the article was fascinating, so I'm looking forward to it.
Oh, good. Well, it may be boring. It'll be right up your alley for this week, then.
I've had people say that about me.
But it's much more. It goes into a lot more of the methodological detail. The methodological detail I'm going to sum up for you in about 10 seconds, just with one slide. So what we did was, we took our existing forecast for state taxes and our existing forecast for Medicaid, because we have models at the state level for all 50 states, and we ran through a baseline forecast, and we said, okay, what would revenues, for revenues, we just took a 2% baseline and said, because when you go in a recession, most states are not looking to match a 5% growth rate. They're looking to just hold harmless, keep everybody the same. So we basically built in the inflation measure and said, what would it cost? What's the difference between states if they went into recession versus just an inflation real baseline of 0 to just say, we don't have to lay anybody off, we don't have to cut anything. And then we took our Medicaid model and we said, well, Medicaid spending is mandatory. They have to spend this whether they want it or not. We put our baseline Medicaid forecast through, and then we ran alternative economic scenarios through it. And we said, well, this is what the world looks like if we have a recession, or this is what the world looks like if we have a great recession. These are the economic scenarios we used. You can see the moderate scenario. That's the one that lines up to that 10.5% number. This is what would be a quote-unquote normal recession, keeping in mind that there's no such thing as a normal recession. But this would be more in line with like a 1991 recession, your everyday kind of every 10-year business cycle recession. Now, our severe scenario here, just to give you some context, I put the Great Recession in here, is basically the worst thing that we could possibly think of that we think is possible. right? Obviously, something could be even worse than that, but you'd be hard-pressed to come up with a real-life economic scenario that's worse than this one. We ran both of these, again, through our revenue models, and we ran them through our Medicaid models, and then we put together a kind of a combined fiscal gap for this is how much money a state would have to have put away in order to get through 2 years without having to raise taxes or cut spending. And we came up with a score or a fiscal gap for each state in the country. And what we found was that there is a lot of differentiation from one state to another, which is why, again, 5% may have been the right number in 1977, but that wasn't the number for every state. 10.5% is our number now, but there's a huge range in terms of where those states go. So the largest state that needs a fiscal gap is Alaska. Anybody have an idea why?
They're relying on the gas.
About 75 to 80% of their revenue comes from oil and gas. And so that thing can turn on a dime. So they actually need a reserve fund of about 45% to get through fluctuations from a recession. That's a moderate recession. Now, the good news is that Alaska has a permanent fund that has somewhere, or at least it did, have about $11 to $13 billion sitting in it. And so they were very well covered. They have dipped into that quite a bit in the last several years, and it's no longer at $11 billion, but they've been able to survive a lot of fiscal stress because they had this major reserve fund put aside. And it's one of the things that most of the energy states are really good at. They're the best at. When they do impute a severance tax, what they do is they don't just take that whole severance tax and shove it into the general fund. Usually what they'll do is they'll say, we're going to put all of this, there are two ways of thought. They'll say, we'll put a certain percentage of this in the general fund every year, and everything else will go to this long-term rainy day reserve fund. Or they'll put everything in the long-term rainy day reserve fund, and they will calculate a 5-year moving average of the value of that fund, and they will put that percentage into the general fund each year to kind of smooth things out. It can be a huge help to preparing for that next recession and having a reserve in place if you are an energy state to have that severance tax in place, just because it's so volatile that you don't want to plug that directly into your general fund. You want to have some buffer in between to help get through the business cycle.
One of the things I was going to suggest is that we may be going for about another 5 minutes. Rick, we have a few more slides I wanted to get through on yours. Then I'd like to open it up for questions if that's possible.
That's great, because I only have one more slide.
Well, I knew. That's why I just thought I'd let everybody know where we are.
Alaska is at one extreme of this, right? The other extreme of this is an extreme that Pennsylvania is on, and for a good reason. There's not a lot of things we can say Pennsylvania is at the extreme on, and from a state budget perspective these days, for a good reason. This is one of those things. So you look at the green states, Pennsylvania is green. Pennsylvania is green because the fiscal gap that it needs to fill is one of the lowest in the country. It's just under 7%. Which is, there's only maybe 2 or 3 states that are better than that in terms of the lower fiscal gap. And the reason it has such a low fiscal gap is that it has such a stable tax policy in Pennsylvania, right? We don't have really progressive personal income taxes in Pennsylvania. We have a flat, 3.1% personal income tax. 3.07. We are very cautious in terms of that, so we don't put all our eggs in one basket, so to speak, in terms of the progressive income taxes. We rely a lot on sales taxes, which again are very stable, and we rely a lot on property taxes, which again are very stable, both at the state and the local level. What that means is that when we go into a recession, the dip in revenues is not very large in Pennsylvania relative to everyone else. So if you look at like California or New York's, they see huge dips in their numbers. That's why they're yellow in here. It's 11 to 19% in New York, because they rely so heavily on those personal income taxes and those very progressive personal income taxes. So the good news is that when we do go into that next recession, because it's not an if, it's a when. It's one of the few absolutes in economics is I can guarantee you 100% there will be another recession. I can't always tell you when that recession will be, but I can tell you that another one is coming. Pennsylvania will be in better shape in terms of it will have less of a crisis on its hands in terms of trying to fill that budget gap. Now, I'm an economist, and so I'm required to follow any good news with bad news, because I have to have two hands as a two-handed economist. The bad news is that Pennsylvania is in very bad shape in terms of having any reserves on hand to be able to offset that decline. As a matter of fact, Pennsylvania is one of, if not the worst. When we looked at the National Association of State Budget Officers data, we found that Pennsylvania, as a share of its general fund, to get through the S3 recession, needed about 6% of its general fund put away to deal with the tax implications, and about 1.3% to deal with the Medicaid increase. And so that combined is about a 7% bogey for Pennsylvania hit. At the end of fiscal 2017, according to the National Association of State Budget Officers, and you all may have more up-to-date numbers than that, Pennsylvania had a minus 1.8% reserve because it had actually run a deficit in the previous year. So not only did we not have a reserve, we actually had a negative reserve, which we were only maybe one of 2 states in the country to have that going into last fiscal year. And so the result is, and kind of to wrap this up, it's extremely important for the state of Pennsylvania to know what's going to happen during the next recession. And you're never going to see a better time to do that exercise in the next year and a half, because the economy nationally is never going to be better than it's going to be over the next year and a half. I would strongly encourage you all as policymakers to have your staffs do some kind of analysis like this, because we can do as best as we can with these large numbers that we have, but no one can do a better stress test on Pennsylvania's budget than the people who are actually in the weeds with the data here in Pennsylvania to do that stress test. You can come to someone like us or somebody at one of the universities to help you do that, but I strongly encourage you to do that, because the first step in putting aside enough revenues for that next recession is knowing exactly how much you need and planning out accordingly for what you're going to do when that next recession happens, because it's not an if, it's a when.
Dan, that's been outstanding. And what I'd like to do is segue back into Rick's presentation, and hopefully the computer doesn't crash when we switch back on PowerPoint. The reason I wanted to do that is the last part of Rick's was an issue about the rating agency evaluations. And after you hear Dan's economic projections in combination with what we've already looked at with the Independent Fiscal Office, and then you look at the information that Rick is about to prepare, it will really bring up to why this was such an important topic for us to be able to go forward. And what I would do after that then, Rick, when you've done that, is I'd like to open it up for questions. John, I would like to ask if you can make sure that Stan, I'll get copies of all the materials to you for Stan, and I would like to see if that's something that we could request from our Financial Rescue Caucus, if the members agree, to ask that the Independent Fiscal Office and the Appropriations Department stress test the revenue and the assumptions. So, Rick, let me go ahead and turn it back to you.
Okay, I'm on slide 12, 3 more slides to go.
And Rick, is your mic on?
It is now, thank you. Yep, very good. This is just a highlight of what the various rating agencies have said about Pennsylvania relative to pension funding and supporting their downgrade of our credit rating. And they continue to underscore that annual contribution levels are well below actuarially required levels. I'm not sure how they define that term, actually, but the important point is we have underfunded our plans for many, many years, which is one of the reasons we have an unfunded liability. And they say it signals an inability or unwillingness on the part of political leaders to make difficult fiscal decisions. And then Moody's downgrades talked about growing pension liabilities. Standard & Poor's has expressed similar concerns. There's a convergence here in terms of what the credit rating agencies are saying about our inability to get this debt, the unfunded liability, under control. I thought this was an appropriate slide from a few years ago, the Wall Street Journal. I think this nailed it as far as I'm concerned. It says pension failures are never about the numbers, they're about human frailty. People are tempted to promise more than they can deliver. Elected officials knew by the time benefits came due they would be out of office. And what's needed is to impart a sense of urgency to convince cities and states that pension underfunding has to be dealt with now, like any other fiscal shortfall. And they say if you want government to come clean, go after their drug of choice, which is credit. When we talk about a war on drugs, well, this is a variation on that. In terms of a public policy principle that I would leave with you is what belongs to you, you tend to take care of, and what belongs to no one or everyone tends to fall into disrepair. And that raises the question, who owns the unfunded liability of the public pension system, the defined benefit system? And I'll let you think about that. And then finally, over 200 years ago, Thomas Jefferson, not an actuary, I would point out, he said we should all consider ourselves unauthorized to saddle posterity with our debts and morally bound to pay for them ourselves. And so I'd leave you with that. And just two footnotes I would mention. One is I hear about school districts, and they have these reserves, and they talk about $4 billion of accumulated reserves, and I can appreciate some of these are earmarked for capital projects, but in my view, the term free cash reserve is somewhat illusory because the unfunded liability of the pension system in which they participate is about 10 times that.
Yeah.
So you got to put this in context in terms of what's on the balance sheet. And I hear sometimes people talk about the pensions are crowding out other important items. Well, I would point out that we've underfunded our pension systems, so I think the pension systems are being crowded out. And if the contention is that pensions are crowding out, pensions are no more than deferred wages. Well, maybe salaries are crowding out other benefits. And this has to be looking at sort of in a holistic way, and just sort of leave you with those thoughts. Thank you.
Fantastic. Hey, first of all, thank you so much. What I'd like to just remind all of us is that we'd like to go on for about 15 more minutes, if that's acceptable with both all the members and Rick and Dan, if that's okay. That'll keep us at about the 90-minute mark, which is a good segue for anything that goes up on YouTube and on TV as well in the process. So, questions?
Richard, you had mentioned that in the aggregate, pension plans should be funded annually as benefits are earned and completely paid up, and that at least for the actuarial assumptions to be considered reasonable, at least 50% are likely to be achieved or exceeded. Given Pennsylvania's path right now, what is that percentage likelihood that we will be able to do it on the current path?
At 7.25%. The plans have said exactly 50. That's a debatable point. That's based on their analysis and the actuaries. In my view, it's probably less than that. And candidly, I'd be happy with at least 50. Doesn't mean 50. I'd be happy with 75 or 80, something a little more conservative. If we were doing our own financial planning, I think we would want a retirement plan that has a likelihood of at least 75 or 80 and not just a 50-50 flip of a coin type proposition. So I would, and just to go on the record, I'd like to see an assumption somewhere between 5 to 6%. That would give me a lot more now we're going to earn whatever we're going to earn, but I think that's probably a more realistic and that gets into how much risk the pension plans are taking and all those questions.
Dave, did you want to answer that as well, or?
I was just going to say, talking to state, and if you talk to the ratings agencies, if you talk to the kind of experts out there, the GFOAs and the GASBs of the world, about 75 to 80% is about their bogey that they're looking for.
If you look at the reserves that we conceptually should have, which is, as you, I think, so eloquently state, Dan, is somewhat of an assumption, because as I'm an economist as well, that our science is not quite the same as an actuary science. But that number, if you were to put it in the 10 to 12% range, would imply about a $3 billion reserve for the Commonwealth.
Well, for Pennsylvania, so the average state, it's about 10.5%. For Pennsylvania, it's lower. So for Pennsylvania, it's about 7%.
Okay.
Yeah. So I would certainly err on the north of 7% side, because that's for a moderate recession, and there's certainly a possibility that the next recession is much worse than that. But one of the things that we pointed out in our paper, and I'll show this to you, was the states that were orange on the graph were within 5%. I'm acutely aware in any elected official worth their salt is, if we go into recession, is probably going to look to cut something or raise revenues for something, right? They're not going to just say, well, we're just going to backfill everything out of the reserve. They're going to cut something. Within 5% or so of cuts, that's doable, right? It's achievable without having severe pain. Anything above a 5% cut or tax increase, that is an extraordinary fiscal measure that can have very damaging results on the underlying economy. And so to be within the 3 to 7% range would be enough to prevent any severe fiscal actions from having to be taken for a moderate recession.
So you're looking then between $1 billion to $2.5 billion of reserves.
I don't know the denominator I'm working with, but yes, somewhere in there.
Okay. And then, Rick, if I were to ask you a similar question, to get to a funding number that would be reasonable, and just to be fair, I talked with Representative John McGinnis about this as well, in light of our current budget, about what additional funding should be done in this current budget cycle. And again, without it being an actuarial science for his perspective, he gave me kind of a back-of-the-envelope calculation, was about an additional $1 billion, $1.5 billion. Does that sound reasonable from your perspective?
Yeah, it does, and it's not all at the state level, which is good news and bad news. But that's the order of magnitude that we'd be looking at.
Okay, so you're talking then a combination of the two, recognizing that a reserve is really a one-time payment. It's not paid every year, but...
Right, well, keep in mind, though, I mean, one of the best way to build a reserve is to build it up over time. I mean,
Sure.
to take 7% of the budget and just stick it in a reserve fund all in 1 year would be just as disastrous as having another recession, so...
What I'm concerned about and where I'm heading with, I agree with that 100%, but what I'm concerned about it just a little bit, and I agree with your assessment that a mid-2020 recession is likely. I've not seen one go quite this long, although this has been a different type of a recovery than I've ever experienced as well.
Right, now, keep in mind, time doesn't necessarily mean that's how much we've regained. If you look at the cumulative growth of that time period, it's been much lower than previous recoveries.
Absolutely.
It's just been a very long and relatively, I mean, it's predictable. I mean, if you were to go back to 2011 and just say 2% growth and 200,000 jobs a month and draw a straight line, you'd be the most accurate forecaster out there.
Absolutely. So, but the question I would then bring up, even if you built it up over time, it's a fairly large number, and the longer that and this is more of a question, the longer that we wait to fund the pension properly, the greater the need to start to play an even greater game of catch-up. Is that accurate?
That is very accurate. And keep in mind, the recession that Dan has alluded to is going to have an adverse impact on the pension fund. I mean, it's very easy to sit here and assume whatever you want to assume, say 7.25, that this goes up in a straight line. Well, if we have a recession, we could lose 10, 15, 20% of the fund. Now you've really got a problem in terms of, you think we have a deficit now. You're looking at insolvency, conceivably. I mean, that's a risk. I'm not predicting that. But then what happens then is the plans revert to a pay-as-you-go basis, and the annuity payments have to come out of the general fund. A dollar in goes a dollar out. So there is volatility, and the likelihood of a recession is bad news for pension systems.
Right. And one of the reasons I should point out that we didn't include pensions in our stress test is because those are usually amortized out over a very long period of time. And so Rick is absolutely right in that recession can increase the ARC payments that I know you hate that term, but they would increase how much you actually have to spend out into the economy or into the pension fund. But that's something that happens over a very long period of time, and it's not something that will necessarily affect you over the immediate 2 years following that recession.
Okay. One of the things, and again, Judy and others, if you have questions, just knock me off, and we'll keep going. But one of the things I'm a little concerned about as well, with the fact that we have been paying as you go on the health insurance plans. Do you have any perspective on what you believe that number will be in terms of an unfunded liability that we'll book? I saw the number in your chart, and I was not 100% sure if that's what the unfunded liability is from a present value perspective. So you think it's only about the $9 billion number?
Yes, although I probably wouldn't use the word only.
Well, I've been hearing. No, I agree. I agree wholeheartedly. What I've been told is somewhere in the neighborhood, it could be as much as 800 million. I'm sorry, excuse me, 80 billion. statewide? Is that not
For,
unfunded healthcare and post-employment benefit cost?
I've never
think
seen
that-
anything that high. Well,
Okay.
at the state level or?
The state level
Well,
and
that could be the pension number and the OPEB number combined.
combined?
Yeah, I don't-
Okay. So you both have seen that number in about the $9 billion range?
I have not spent as much time on it as Rick has.
Okay. And Rick, what type of actuarial assumptions are they using on the growth in medical cost? Is that different than the growth rate that we're using?
I'd have to get back to you on that. That's in the actuarial report, but I don't know specifically.
Because that's something I would really like to see. Is just my experience from what I've been hearing from the Appropriations Department is that health insurance costs are increasing at a fairly
Well,
significantly higher
Yes,
rate.
and keep in
than
mind, this
salaries.
is for retirees, and that has two pieces to it, pre-65 and then Medicare, because very often states and, employers, they offer a Medicare supplemental plan. And it's important to underscore the precarious state of Medicare, which has a tremendous unfunded liability. And I think that's going to be very problematic long-term, and that gets back to OPEB, of course, because we're supplementing that. So, we've got some problems at the national level as well.
Judy?
So for folks listening at home and for takeaways today, how can we prepare for the next recession? Give us just a few quick talking points.
Sure. No, it's a great question. So that's a question I get a lot from states at this point, because if you don't have anywhere close to your reserve fund yet, you're not going to have it by the time the next recession happens. Now, I would say that Pennsylvania has a unique opportunity because Pennsylvania, again, is an extreme in terms of it has a very small bogey that it has to hit to be prepared for the next recession. So 7% for the next recession. If you can get within 5% of that, if you could get to 2 to 3% from where you are today, that's a huge win going forward. And that's something that you could do if you put 1% away every year for the next 2 years. That gets you at least into the ballpark of not having to make so severe a spending cut or a revenue increase during the next recession when that comes.
Okay.
One of the things I just wanted to somewhat wrap up on is, first of all, I wanted to thank both Rick and Dan for coming down and for the members for being here today. And John and Barry, thank you for being in the audience as well. We're going to get this out to all the members for them to review. We will be sending out the information as well that you sent to us electronically. I would ask Dan if you could send that other report down to us. It'd be very much appreciated. And what I wanted to explain why we're doing this is it's part of a financial series on issues where we wanted to look in depth at topics that most people don't know well, but yet, if not dealt with effectively, could have catastrophic implications on the financial solvency of the state. I've often made a comment to people that I hear that there's a legal requirement to keep paying the bills, and I agree with that. And I will also say, though, is that if you look at the Independent Fiscal Office report, the outlook with the migration of younger people out of the Commonwealth is not good. And your comment about Medicaid is particularly germane when you see that right now 1 in 5 Pennsylvanians is 65 and older, and 1 out of 4 in the next 5 years are expected to be 65 and older, where the vast majority of the Medicaid patients are in fact over 65. And we've gotten that information from an aging committee meeting I was on the other day. So what I'm concerned about is there will become a period of time that if we're not careful, it's the whole reason for this caucus, that the financial solutions to what we need to do will become so severe that there will be no political appetite to do it. Rick, you mentioned the word solvency, and John McGinnis and I have had this discussion before. No one believes that in the next 2 to 4 years we're insolvent. What we believe, if we don't start to tend to the issues in the next 2 to 4 years, we could be. And the greater the degree of a recession going forward, the worse that will be. So any final closing comments from anyone?
Frank, actually, I'd like to ask, I want to thank both of you for keeping it to the numbers and keeping it simple. I think this is something that will actually translate. It's interesting, when Act 9 was passed in 2001, my dad had told me, he said, go ahead and sign up for that. He was already retired from the state. He said, he said, the funds will be bankrupt. And he saw it back then, and immediately, this was, like I said, 2000, 2001, and we saw that downturn and the immediate underfunding from funds that were fully funded at one time. And then the actuarial note that Richard, you brought up, and then the follow-up on Dan did not want to deal with the 2008 downturn. That was the political realities of what were going on. It was the politicians, the people that were watching their funds being raided, in effect, understood it because it was a topic of discussion. I was just a CO1, corrections officer. We understood that we were getting stiffed back then. And now you've been able to put it into a way, I think, that if anybody is seriously interested in taking a look at this, you've kept it simple enough, although it's not, this isn't 1 + 1 = 2, but it is still something that anyone who is concerned about their retirements and concerned about the issues that we have to face as legislatures as far as funding the pension systems and the hurdles that we're going to face with the economy, the fluctuations in the economy. These are things that are very informative, and I want to thank you both.
Thank you very much.